Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the previous lesson, we have learned 3 items under operating expenses in the income statements: SG&A expenses, R&D expenses, and depreciation and amortization expenses. We have also learned a key term, operating margin, which can tell us a company's profitability after including cost and operating expenses. However, the net income is key to determine a company's competitiveness. In this lesson, I will walk you through the concept of the net income. 1. What is net income? In this chart, we can tell that net income is equal to company's total revenue minus cost of sales, operating expenses, other expenses. To put it simply, net income is the residue income through a company's operation. It's similar to how much money you saved after deducting taxes, rent, daily expenses, and etc. Here is a new term, other expenses. It refers to all income and expenses that are not directly related to production and operation. The key point is, not directly related to production and operation. When you read financial reports, you can't just look at the net income of a single year. Instead, I suggest you compare 5 years' data. By observing the net income over 5 years, you can judge whether this company can continue to maintain its growth and whether it is truly competitive or not. Historically, only a few companies have enjoyed smooth sailing in the long term. We don't need to demand a company's net income trend should always go up. For example, when the pandemic broke out, many companies suffered greatly. After excluding these macro factors, a company is competitive if its overall net income trend is upward. 2. How to interpret net income. Next, let me use the data in Tiger Trade app as an example. First of all, open Tiger Trade app, enter with the stock ticker, click Company, click Financials to see the net profit trend chart. Let's take Microsoft as an example. Looking at the net income growth curve over the last 5 years, we can tell that the net income shows an overall upward trend from 2017 to 2021. The net income growth rate declined significantly in 2020 because of the pandemic, but stabilized in 2021. Since the pandemic has greatly impacted the growth of net income in the last 2 years, you can extend the selection of net income data to 10 years, which may present a clearer picture of the net income trend. By comparing net income data in the past 10 years, the trend is upward overall. From this aspect, Microsoft has good profitability. As we mentioned in the previous lesson, if we focus on gross profit, we would choose Rose's company as its gross profit is higher. What if we focus on net income? Let's compare the two companies. After comparison, we find that the net income of Rose's company is still higher. But what if Jack's company had total revenue of 10 million USD and net income of 10,000 USD? This time, Jack's company will have higher net income. In this case, we need to introduce the concept of net income margin. 3. How to calculate net bid income margin. The net income margin is equal to net income divided by total revenue. From this formula, we can tell net income as a proportion of total revenue. The higher the ratio, the higher the profitability, and vice versa. With this in mind, let's revisit the case above. Rose's company's net income margin equals 2,940 divided by 6,000 equals 49%. Jack's company's net income margin equals 10,000 divided by 1 million equals 10%. Obviously, Rose's company enjoys a higher net income margin. If this trend persists in the long term, Rose's company will generally be considered to be more competitive. In order to help you better understand the net income margin, I have listed some well-known companies in the chart below. For example, the 5-year average net income margin of financial giant Moody's reached 24.79%. Microsoft reached 24.08%. Wells Fargo Bank and Apple reached 22.11% and 21.36% respectively. These companies have great competitive advantages in their industries. You have probably noticed that Southwest Airlines and Ford Motors have relatively low net income margins. What does this mean? On the one hand, company may generate less profit in their operations. On the other hand, it reflects the excessive competition in the airline and auto manufacturing industry. The chances of an investor to make good investment return in an overly competitive industry are low. Generally speaking, if a company can maintain its net income margin consistently above 20%, it is deemed to have long-term competitive advantage. On the contrary, if a company's net income margin is consistently below 10%, it is probably in an excessively competitive industry. Of course, there are exceptions. Companies like Coca-Cola and Merck have long-term net income margins of 10 to 20%. Such companies could have great potential. Once their operation improves, investors of these companies may make huge profit. Therefore, the growth and development of such companies deserve our attention. So that's all about net income margin. Now let's reveal the key point of the income statements. In this section, we first learned about the framework of the income statement, including total revenue, expenses, and net income, and then compare the income statements to personal budgets. Next, we learned a few formulas. Net income equals total revenue minus cost of sales minus operating expenses minus other expenses or income. Gross profit equals total revenue minus cost of sales. Gross margin equals gross profit divided by total revenue. Operating margin equals operating profit divided by total revenue. Net income margin equals net income divided by total revenue. I would like to remind you that you don't have to memorize these formulas, as most of the financial data is available on Tiger Trade app. You can find them by clicking the company button on the interface of the stock. Through the formulas, we drew several important conclusions. 1. High total revenue alone is not necessarily better. 2. Companies with gross margins above 40% tend to have competitive advantages. Companies with gross margins below 40% are generally in excessively competitive industries. As excessive competition decreases industry profitability, we're better off staying clear of any stocks in a sector with overall gross margin below 20%. 3. To be objective, we should look at gross margin over at least the past 5 years to ensure one company's consistent profitability. 4. When we screen companies by operating margin, this metric should be above 10%. 5. If a company can maintain its net income margin consistently above 20%, it is deemed to have long-term competitive advantage. If, on the contrary, a company's net income margin is consistently below 10%, it is probably in an excessively competitive industry, where no company can do well. Finally, I would like to summarize with a chart. That's all for this lesson. It's not nearly as hard as you imagined, right? In the next lesson, I will walk you through Apple's 2021 income statement to give you hands-on experience. See you next time!